Okay, welcome back. So here we are to get started with step one of the calculation for the current income tax expense. So when we're doing tax accounting, we're essentially looking for two different numbers. We're looking for the current tax expense for the year, and we're looking for the deferred tax expense for the year. And both of those could be a benefit. So if it ends up being a debit, it's going to be an expense. If it's a credit, it's a benefit through the income statement. So we're going to start with the first calculation being the calculation of the current tax. You could do the deferred tax first, but I'm going to do the current tax expense calculation first. So I'd like to call this one usually step one. Okay, so step one is calculation of current income tax expense. So to calculate the current tax expense, so this is the tax that you actually have to pay this year. We always start with our accounting income and adjust it, just like we would on a tax return, adjust it to the taxable income figure, which is the figure that your tax that you have to pay is based on. So we'll start with that accounting income. For 2016, and that was $80,000. So that's our starting point. And then we're going to adjust this just like you would on a tax return. You're going to adjust this for things that are different between the accounting income and what the taxes are based on. So there are lots of things that are different in the Tax Act between accounting and tax. And given the facts that I gave you originally related to this situation, we've got a few different things. And we usually classify those in this rough calculation here, splitting it between the permanent and the differences that are not permanent, or timing differences. So let's start with the permanent differences. Okay, so in the facts that I gave you, there were three things that happen to be permanent differences. They will never be taxed the same way they are recorded for accounting. One of them is the dividend income. So we had dividend income that we received from Canadian corporations of $8,000. So that's included in that accounting income figure. We don't have to pay tax on that. The tax laws say we don't have to pay tax on that. I could get into a long explanation of why we don't have to, but just the fact is the tax law says we don't have to pay tax on that $8,000 because it's already been taxed in the corporation that paid the dividend. So we subtract that from the accounting income to lower how much we're going to have to pay tax for this year, because we don't have to pay tax on the $8,000 anymore. Another item that is considered a permanent difference is fines that we expensed. So we paid some fines and we expensed them in this $80,000 this year, and they were for $3,000. And the tax law says that you are not allowed to expense for taxes anyways. You can't deduct those $3,000 worth of fines. You're allowed to, it's a legitimate business expense because you did pay it. You're allowed to expense it for business, so it's okay that it's subtracted in the accounting income, but it's not okay for calculating your taxes owing, so you add it back. And the other one in the example that I gave you was meals and entertainment expense. So M&E for short. The tax law currently says that 50% of your meals and entertainment expense are not allowed to be deducted for tax purposes. So we had meals and entertainment expense of $7,000, I believe. So $3,500 is not allowed to be expensed for tax. So we'll add that back into the accounting income. So those are our three permanent differences. Now there are other differences, though, that are different between accounting and tax, but only in this particular year. So it's saying that it's something that's in this accounting income or not in this accounting income, but should be in the taxes figure for calculating the taxes that are owing. So a couple of examples of those, and we'll call those timing differences or temporary differences. So one of those is related to depreciation. Okay. So there is depreciation that has been expensed of $80,000 in there. That is not a legitimate expense for tax purposes. However, For tax purposes, you're allowed to take capital cost allowance, or CCA. So the CCA for this year, for 2016, works out to $3,000, and that can be subtracted for tax purposes. So let's just take a look at these numbers here. So this particular one was from the accounting net book value, where we depreciated $2,000 per year, whereas this was related to the undepreciated capital cost allowance that ended the year last year, $25,000, and I think it had a tax class rate of 12%, so $25,000 times 12%, that was the amount that was allowed deducted for tax purposes. So those two things will not be the same this year, but eventually that whole asset that was purchased, the whole property, plant, and equipment asset, eventually for accounting it will all have been expensed down to a net book value of 0, and eventually for tax, in theory anyways, it will eventually all get deducted as CCA over many years to the point where it gets down to a class value of 0. So eventually they both do get fully expensed, both for accounting and for tax, but in any given year there can be differences. So in this year you can see that there's a difference of $1,000 where you can have more deduction for tax than you can for accounting of an additional $1,000. Another timing difference was the warranty. So this year we actually spent $8,500 repairing some products that we had sold in prior years and we had accrued as a warranty liability. So the entry, when we did this, when we paid for these repairs to these products, would have been a debit to the warranty liability and a credit to cash or accounts payable or whatever inventory that we had. So $8,500. So you can see this entry didn't do anything to our income statement, so it had no effect on our accounting net income. The entire warranty had been expensed in the prior years, but this year when we actually spent some money, we just drew down the liability. Well, for tax purposes, you're only allowed to deduct this when you actually pay the warranty. And I almost had a little mistake here. Can't forget the brackets. So you are allowed to subtract this or deduct the warranty when you actually pay it. So this is the actual amount spent. So this can be deducted for tax purposes this year. Okay, so that's the warranty. Another item we had was our restructuring liability. This accrual that we made of $10,000. So that restructuring liability, why are we adding it back? We're adding it back because when we recorded this liability, we would have expensed it. So debit the expense, credit the liability. That expense is therefore in that net income calculation, but the tax laws say that you can't expense for tax purposes a liability that's just an accrual and hasn't actually been incurred. So we're going to add it back this year, and then in the future years, next year or whenever we do get around to restructuring the plant, then we'll deduct what we actually spent. So it's very similar to this warranty situation. So we'll add back this expense we've expensed for accounting for now, but in future years we're going to deduct it. And then the last one that we had that was a timing difference was related to the rental income that we had accrued. So we had accrued $6,000 worth of rental income. So the journal entry when we accrued the rental income was a debit to some type of receivable. So it could be rent receivable or something. I'll just say accounts receivable for simplicity. So the entry we recorded in 2016 was a debit to the accounts receivable and a credit to rental income, $6,000. So this rental income value is included in this net income of $80,000, but we haven't yet received the money for it. And the tax law says that we don't have to pay tax on this $6,000 until we actually get the money from our customer. Even though for accounting we needed to accrue it, we don't have to pay the tax on it. So we're going to subtract it this year, and then next year when we do collect this accounts receivable, then we're going to have to add it back to include it in our income for tax purposes. So these are all the total permanent and timing differences. When you do this calculation, technically you don't need to split it up between the permanent and the timing differences. The two categories there, this is just rough work. The reason it's a good idea to split things between permanent and timing differences is because we're going to use these timing differences. These are going to help give us a clue when we get on to the next stage, step 2, where we do the deferred tax accounting calculations. These are going to give us a clue of the kinds of things that we've got floating around that will affect our deferred taxes. So after you've identified all your permanent differences and timing differences, anything that is different between accounting income and taxable income for this year, you can add them all up, you get your taxable income for this fiscal year. And that taxable income will likely be, and hopefully will be, the same taxable income you get when you do eventually get around to doing your tax return. Usually you're doing the accounting for taxes well before you get around to actually doing the formal tax return. But our expectations are that this is going to be what your taxes payable for this year is based on. It's going to be based on this taxable income figure of $73,000. And you multiply that by the current year's tax rate, so whatever the legislation says you have to pay tax on this year, and we'll just make an assumption of a simple 20% rate times the $73,000 taxable income. This is your current tax expense. So it's not the whole tax expense for accounting purposes, it's just the current portion. So you'll debit that tax expense of $14,600 and you'll credit a current income tax payable liability that you have to pay to the government. Okay, so that was the completion of the current tax calculation for 2016. We'll have another video a little bit later that will summarize all the journal entries for tax accounting. But for now, we're finished this calculation, and whenever you're ready, you can move on to the step 2 calculation of deferred taxes.